We aren't just talking about a Bitcoin miner anymore. We are talking about a company that just pulled off a, a massive pivot, signing a $9.7 billion deal with Microsoft and watching their revenue just explode by 355% in the last quarter. This is the story of the Great Compute Pivot. Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at IREN.
And if you find our talks useful, please consider subscribing, like, and comment underneath.
So IREN, formerly known as IREN Energy. If you've been in the crypto space for the last few years, you probably know the name. But if you look at the headlines today, Friday, January 23rd, 2026, you might be wondering if you're even looking at the same company. They've fundamentally changed their identity.
It's a complete metamorphosis. It really is. They've gone from a pure play crypto miner to what is, well, it's essentially a high-performance AI infrastructure utility. And the market is honestly trying to figure out how to value that. It's a fascinating transition. I like to call it the mullet strategy of the stock market.
The mullet strategy. Okay, I usually roll my eyes at these analogies, but I have a feeling you're going to tell me this is business in the front, party in the back.
Exactly. But hear me out. In IREN's case, it's Bitcoin mining in the back. That's what provides that immediate massive cash flow and then massive AI cloud services up front. That's the future growth story. The mining, it pays the bills, keeps the lights on, while the AI side, that's where the explosive potential is. It's a hybrid model.
That's a helpful visualization, actually. But let's be honest, usually when a company tries to do two very different things at once, mining crypto and managing huge enterprise cloud contracts, they end up doing neither of them well. It's a classic capital allocation trap.
Yeah.
You have this legacy business just printing money, funding a new capital-intensive future.
Right.
But let's look at the price action because, despite all this big news we're going to discuss, the stock has actually pulled back.
It has. We are looking at the stock sitting around, what, $40.30. It's down about 5.5% recently. And this is after a massive run-up. We're talking 300% over the last cycle. So the question we really need to answer for you today is this pullback a warning sign, that the hype is over? Or is this a rare buying opportunity before the next leg up?
And to answer that, we have to look at the numbers. And the financial turnaround here it's staggering. We aren't talking about small incremental growth where they eked out a 1% gain. We are talking about swinging from a loss to a net income of nearly $385 million in Q1 of fiscal year 26.
That is the headline number that just stops you in your tracks. Let's unpack that revenue explosion because it really anchors the bull case here. You just can't fake a turnaround of that magnitude.
No, you can't. So let's look at the trajectory. For fiscal year 25, revenue hit $501 million, up 168%. Great. But the real story, the step change, as analysts are calling it, is Q1 of fiscal year 26. Revenue hit $240.3 million just in one quarter. That is up 355% year over year.
355%. That is absurd growth. And what's crucial here, and this is where so many growth tech stocks fail, is that they aren't just growing the top line while burning cash. They are profitable. That net income figure we mentioned, $385 million, that's real money. They flipped the switch from burning cash to generating massive income.
But let's dig into why that switch flipped. A huge part of that confidence comes from what we're calling the anchor. This deal with Microsoft, this isn't a pilot program or some small test run. This is a $9.7 billion 5-year AI cloud agreement.
This is where it gets really interesting. Think about the business model difference. When you are a miner, your revenue is volatile. It depends on the price of Bitcoin, difficulty, halving events. It's a roller coaster. You wake up one morning, Bitcoin is down 10%, and so is your revenue. But a cloud contract with Microsoft, that is guaranteed recurring revenue. It's boring in the best possible way.
It stabilizes the ship. They are projecting over $500 million in annual recurring revenue, or ARR, by early 2026. And the long-term goal, they're aiming for a $3.4 billion run rate eventually. That completely changes the risk profile of the stock. It moves them from a speculative commodity play to, well, a utility play. But I have to play devil's advocate here. Microsoft is the biggest company in the world. They have infinite resources. Why IREN? And why did Microsoft, and Dell for that matter, choose this specific company? There are plenty of data centers out there. What makes them so special?
It comes down to the moat. In the AI world, everyone focuses on the chips, the NVIDIA H100s or the Blackwells. But the scarcest resource right now, it isn't silicon, it's power.
And we keep hearing that the grid is congested. Is it really that bad?
It's worse than most people realize. In many parts of the US and Europe, if you want to build a new data center today, the utility company will tell you, great, we can hook you up in 2030. The lead times for high-voltage transformers for substations are years long. IREN has secured 3 gigawatts of power capacity. To put that in perspective, that is enough to power a major city. And it's not just any power.
Right, it's 100% renewable energy. That's a huge box to check for Microsoft's ESG goals. They can't just plug into a coal plant anymore. But having the power is one thing, having the facility is another.
Correct. And this is where their vertical integration comes in. They own the land, they own the substations, and they own the data centers. They aren't relying on third-party colocation facilities, the colos, where they have to negotiate for space or power.
So they control their own destiny.
Precisely.
So when Microsoft needs to deploy a massive cluster, IREN doesn't have to ask a landlord for permission to upgrade the cooling systems or drill through a wall.
Exactly. And that vertical integration translates to speed. Speed to market is everything in this AI arms race. Microsoft is in a war with Google and Amazon. They need capacity now, not in 5 years. And that capability has earned IREN preferred partner status with NVIDIA.
Which is huge. And let's not forget the $5.8 billion deal they have with Dell for chips. In a world where everyone is fighting for GPUs, having a guaranteed supply chain through Dell and that status with NVIDIA means IREN can actually deliver on these contracts. They aren't just selling vaporware. They have the chips secured.
So, all right, let's recap the bull case. You have massive revenue growth, a nearly $10 billion contract with the biggest tech company in the world, and a power moat that is incredibly hard to replicate. I mean, you can't just magically create 3 gigawatts of grid connection. It's no wonder Wall Street is generally bullish.
The consensus is a moderate buy, and when you look at the price targets, the average is sitting around $67 to $70. But looking at the more aggressive bulls, some are calling for $80 or even $100 a share.
So if you're buying at $40.30, that implies a potential upside of anywhere from, 50 to 100%. The institutional confidence is there too. We saw Farther Finance Advisors recently increase their stake. Institutional ownership is sitting at a healthy 41%.
It all sounds perfect. Almost.
Yeah.
Too perfect. You know, whenever a story looks this clean, I start looking for the cracks in the foundation.
Which is usually when we need to take a breath and look at the other side of the coin, because a stock doesn't just drop 5% in a week or pull back from its highs without some valid concerns.
Okay, so let's break that down even further. We need to talk about the bear case, the lowdown on the risks, because this growth,
well, it's expensive.
incredibly expensive. We talked about the money coming in from Microsoft, but we also have to talk about the money they had to raise to build the infrastructure for Microsoft. IREN recently raised $3.9 billion.
And that was a mix, right? It was $2.3 billion in convertible notes and a $1.6 billion equity offering. And for existing shareholders, that's the scary word, dilution. To raise that $1.6 billion, they had to issue new shares. It's like, imagine you own a slice of a pizza. Suddenly the restaurant cuts the pizza into twice as many slices. Your slice just got smaller. That dilutes the value of the shares everyone else is holding.
And convertible notes aren't free money either. That's debt that can turn into equity later, creating even more dilution down the road. Plus, there is this lingering fear of a funding gap. Building these massive high-performance data centers is just so capital-intensive. If they mismanage that $3.9 billion, or if costs run higher than expected, which happens all the time in large-scale construction, they might need to go back to the market and raise more money.
And that's the execution risk. It's one thing to sign a contract with Microsoft. It is a completely different beast to actually build the physical infrastructure. We aren't talking about putting servers in a cool room. We are talking about liquid cooling, high-density racks, getting it all running with 99.9% uptime on a tight deadline.
We actually saw a glimpse of this recently. They had a miss on earnings per share, on EPS, in the short term. And it wasn't because revenue was bad, but because the capital expenditure spending, the CapEx, was so heavy, they were just spending money hand over fist to build this out.
It's like building a factory. The factory costs a fortune before it produces a single widget. And while we are talking about risks, we can't ignore the mullet in the room again. The Bitcoin mining business. They still have 52 exahashes per second of capacity. That is a lot of exposure to crypto.
It is. And while crypto has been hot, we know how fast the wind changes. If Bitcoin crashes, a significant chunk of their immediate cash flow, the money paying for the party, dries up. They are still tethered to that crypto volatility. This gives the stock a high beta, which just means it's going to be much more volatile than the broader market. If you can't handle swings, this might be a tough ride.
Speaking of swings, we have to mention the smart money moves. Paul Tudor Jones, he's a legend in the macro trading world. He trimmed his stake recently.
That raised a few eyebrows. But to be fair, that doesn't necessarily mean he hates the stock. After a 300% run-up, any disciplined investor is going to take some chips off the table. It's likely just profit-taking.
Yeah.
But it does signal that maybe the easy money, that initial explosive discovery phase, might have already been made.
It's a signal that the hype phase is ending and the execution phase is beginning. And the execution phase is harder. It's boring, it's difficult, and it's where companies usually stumble. It's where the rubber meets the road.
So we have a high-growth, high-cost story with some pretty serious execution risks. If you are holding this stock or maybe thinking about buying this dip, what should you be watching? Because you can't just buy and pray on a stock like this.
No, you absolutely need to watch the milestones. Mark your calendars for February 11th, 2026. That is the next earnings date, and it is critical.
This is going to be the show me moment. So what
Right.
exactly are we looking for?
We need to look for three things. First, AI, AR progress. Are they on track for that $500 million recurring revenue target? Any slip up there, any delay in revenue recognition will be punished severely by the market. We need to see that line on the chart moving up and to the right.
Okay, second is capital deployment. How fast are they burning through that $3.9 billion? If the burn rate is too high, those dilution fears are going to come roaring back. Investors want to see efficiency, not just spending. They want to see that for every dollar spent, there's a clear path to return.
And third, Microsoft updates. We want to hear specifics on the ramp-up speed. Are the data centers coming online on schedule? Are the GPUs plugged in and computing? We want operational updates, not just promises. If they say delays due to supply chain, the stock drops. If they say ahead of schedule, we fly.
And zooming out to the macro picture, you also need to keep an eye on interest rates. IREN is a builder. Builders love low interest rates because it makes borrowing cheaper. If rates get cut, that's a massive tailwind for them.
That's a great point. The cost of capital is a major input for their model. If money is cheap, they can build faster and more profitably. And just generally, watch the AI CapEx cycle. As long as Microsoft, Google, and Amazon are in an arms race to spend money on AI infrastructure, IREN is selling the picks and shovels. If that spending slows down, if Wall Street starts telling big tech to tighten their belts, IREN catches a cold.
And there are also some speculative catalysts floating around. Rumors.
Yeah.
Because they are a preferred partner with NVIDIA and they have this massive power capacity, there is chatter about potential contracts with other hyperscalers.
It makes sense. If you are Amazon or Google and you see Microsoft locking up 3 gigawatts of power with IREN, you might get a little nervous. You might want to secure some capacity for yourself. Power is a zero-sum game in specific locations. If another major name signs a deal, the stock goes parabolic.
And potential inclusion in broader indices. As their market cap stabilizes and they become less of a crypto stock and more of a tech infrastructure stock, they might get added to indices that don't touch crypto. That brings in a whole new wave of passive buying from ETFs and mutual funds. That's the structural bid that every company wants.
It really is a compelling setup, but it relies on a lot of moving parts syncing up perfectly. It requires flawless execution from management.
So looking at the big picture here, IREN is a classic high-risk, high-reward play. It's a pivot story. They're trying to use the cash from the crypto boom to build a stable, long-term utility business for the AI revolution. It's like a gold miner, using their gold profits to build a hydroelectric dam. One runs out, the other runs forever.
That is a fantastic analogy. It really is a fascinating setup. You have the stability of the Microsoft contract fighting against the volatility of Bitcoin and the execution risk of a massive construction project.
It's definitely not for the faint of heart. But if they pull it off, the upside is clear.
Here's my final thought for you to chew on. The market is currently valuing IREN somewhere in limbo. It's trading somewhere between a Bitcoin miner and a data center. Bitcoin miners trade at low multiples, usually 4 to 6 times earnings, because their revenue is so unpredictable. Data center utilities trade at high multiples, 20, 30 times earnings, because their revenue is stable and predictable.
Right. The market pays a premium for certainty.
Exactly. If IREN pulls off this pivot and that $500 million in recurring revenue becomes reality, the market is going to have to completely rewrite how it prices this stock. It won't be valued like a miner anymore. It will be valued like a piece of critical global infrastructure. But until those data centers are turned on and humming, it's a show-me story.
And we will be watching closely on February 11th to see if they show us. Thanks for joining us on Smart Wealth with Joshua.
We'll catch you in the next one.